Welcome back to Vetted VA Live, everyone, where we get together every Tuesday night with vetted experts on the real estate and mortgage side from around the country and go through a topic that's coming up in the Vetted VA Facebook group, questions that we're seeing. And tonight, we're going to be covering an interesting one, self-employed borrowers in the VA mortgage. There are definitely some pieces here that are a little bit different. And for those of you who are self-employed, work for yourselves, big questions in how long do I have to be self-employed? What documentation do I have to provide? So we're going to break all that down for you. But remember, most importantly, we are here to answer your questions live. So if you're watching, you have a question, throw your questions up over in the comment section. We will get over to them as quickly as we can. But I will roll around the horn here and introduce all of our experts tonight. So on the top row with me, we've got Gay Veal in Colorado. Colorado Springs, Gay?
Yes.
Perfect. And then we have the only two loan officers that matter in the state of North Carolina. We've got Mike Alberico and Ariel Best representing the far side of the country, the later time zone, and all of that fun stuff. Mike, why don't you jump in and kick us off with, why is self-employed income treated any differently than someone that goes in and punches a clock and gets a paycheck at the end of the month?
Gotcha. I want to preface, if I drop off, I'm on a generator because North Carolina got pounded with storms, so I'll try and get back on, but hopefully that doesn't happen. So self-employed it's great to work with entrepreneurs. You can really build something out for your income and utilize the tax code. And that's the big thing where it comes in, is that utilization of the tax code. While it's completely legal to utilize the tax code in your favor, when it comes to mortgage underwriting across the board, and not just with VA, with conventional FHA, USDA, we have to look at it differently. So like a prime example would be, if you're a W-2 salary individual, say you work for University of North Carolina, you make 60 grand a year, your qualifying income's $5,000. When it comes to self-employed income, we have to look at sometimes 2 years taxes, sometimes one, most of the time with VA, 2 years tax returns. And it's a completely different animal when it comes to qualification. And that's why it's really important to get somebody that knows what they're talking about to review these up front. If you have someone that's giving you a pre-approval and you're self-employed and they haven't looked at tax returns, or you've never worked with them before, run. Because there are maybe a handful of people that I've worked with over my 10-year career that I know how their taxes are going to look, that I may issue a pre-approval for them without reviewing it. But even so, with me being kind of a cautious LO, I'm still going to review them. But that's basically in a nutshell, is W-2, salaried, or even hourly, we just look at what you make. Self-employed, we have to work backwards. We have to take what is basically your net, and we can add back a handful of deductions. And then there's other things that we still have to back out. I'm not going to take over all hour of this, but that's just like basically what it is in a nutshell.
And as we go through it, we're going to go through all of those things and break it down. But when I'm looking here at the outline of what we were talking about and thinking in terms of for the show tonight, realize that almost everything here relates back to income. Gay, other than income, is there anything really different for a self-employed borrower relative to an employee that comes into you? Anything different that you're going to go over with them besides the income component?
Yeah, so if you don't mind, I want to kind of just back up a little bit before I answer that question, and just talk about I think Mike did a great job of talking about how those things are different. But at the end of the day, put in the most simple terms that I can think of is self-employed income's variable, right? And that variability equals risk to the lender. So the lender is going to place much more scrutiny on that income than they are on if it's just regular hourly, it's guaranteed. You get a paycheck. I look at it. It's the exact same pay every single 2 weeks, every single week, however often you get paid, right? And so that is why kind of at the core, self-employed income is treated differently. And there can be huge swings in businesses and what they make. And so, if you're a self-employed veteran out there listening to this, I mean, 1 year you could have just an amazing banging year, and make a ton of money and a ton of income. And then something like COVID can happen and really impact your business. And so, as you can imagine, that's why there's a lot of extra scrutiny put on it. But yeah, I mean, just in general, self-employed income, we're going to look at taxes. So we're going to look at your tax returns. We're probably going to look at your profit and loss statement. I'm sure there's something very specific you want me to say, Josh, that I'm not picking up on.
Absolutely not. I'm not here to guide you in any direction. I'm here to
Josh
ask
is great,
and
though.
see what you guys think.
No, it's wonderful. You ask these wonderful leading questions that help us get to the answer you want. But yeah, so there's a lot. Definitely, there's a lot more that goes into it than just I'm not just looking at a W-2 or a in your pay stubs. We're looking at tax returns, 1099s. Anyway, maybe K-1. Employment. So there's so many, profit and loss statements if you haven't filed taxes yet, so on and so forth. So it's a complex little animal, self-employed income for sure.
You gave some nice foreshadowing there, because we're going to talk about that at the first part of the year. It's a very interesting time of the year for self-employed borrowers. Not quite as interesting for VA buyers, because they're self-employed. We're going to need 2 years tax returns most of the time, but it does give us some flexibility, and we're going to go into the details on that. Whenever we get together or we start at the beginning of the week, we know what the topic we're going to talk about, start looking at an outline. I always kind of like to go through the guidelines and see if there's anything in the VA guidelines that are interesting to me about what we're going to talk about. I kind of like the VA definition of effective income. Kind of going back to Gay, you were talking about variable income. What are the VA guidelines telling an underwriter they should be looking for? So this straight quote here, because I think it's helpful. Income is considered effective when it is determined to be verifiable, stable, and reliable, and anticipated to continue for the foreseeable future. This, to me, was the most important part. Income analysis is not an exact science. It requires the lender to underwrite each loan on a case-by-case basis using good judgment and flexibility when warranted. We get here every week. We talk about VA is awesome because it is far and away the most flexible program. I don't know that I've ever seen anything where in the written guidelines it says use good judgment and flexibility. It's generally black, white, it is what it is. So to determine whether income is stable and reliable, the probability of continued employment must be determined through examination of past employment record, borrower's training, education, and qualifications, type of employment, and only verified income can be considered in the repayment calculation. And that's where it gets a little bit more difficult or a little bit weird for a self-employed borrower. We don't have someone to call up and say, hey, does Gay actually work there and get paid this much every month? We have to analyze the documentation. So Ariel, with that thought, when you have someone that's self-employed coming to you, I know one of the big questions that I often get is, hey, I'm recently self-employed and wanted to know how long I need to be self-employed before I can get the loan. It's kind of a really big question, but when you have someone that maybe doesn't have a full 2-year history, where do you go with that?
I normally will start asking questions. I get real nosy, because it depends on a lot of different factors, because the handbook doesn't say that it's not doable. And I've had some weird circumstances occur before. So I normally will get as much context as I can surrounding, is this a new venture you're starting? Is there licensure required to be in the self-employed line of work? Is there anybody that you are having to intern under? You might be 1099, but you might be guaranteed a certain amount of income as a 1099. There is actually some skill bridge programs that kind of segue you into a 1099 position. So I try and get as much of the context as I can. I have only ever had one veteran that was eligible to do 1 year of self-employed business returns. We have to have at least 1 year recorded with the IRS. That being said, once we have that 1 year, we get a lot of context. So I normally start with, hey, when did you establish the business? I did actually caveat to that. I'll tell you one example that I just had. I had a veteran who bought a business, and the business was established for 7 or 8 years. The LLC was established early on, and we're allowed to use that income effective immediately due to all the things that are already established for that business and the fact it's already got its own tax returns. So there are exceptions, very specific exceptions to the rule. But aside from buying a business that's already established or having 1 year, those are typically where we start. From there, if it's 1 year, we need to be able to document pretty sturdily that the income is stable and likely to continue. Typically for self-employed veterans, it's going to be in fields that are fairly high demand. I've got one veteran who's running a, I'm going to lose the kind of business he's running. It's a very high desire business. He's doing very well with at least 1 year on tax returns, but minimum of 1 year. And we use the worst case scenario. So for that veteran that's got 1 year on tax returns, underwriting is requiring that we're averaging over 24 months. So there's a lot of different ways. We use a lot of different worst case scenarios because ultimately we're worried about whether or not you can repay this mortgage. How can we verify the worst possible case that you can still repay this mortgage, right? So we start with that.
That 1 year is important for the purpose of, we don't have anything without that. I'm sure you guys have all got some version of the question around this time of year. Hey, I started it last year. Well, we're in January, and if we don't have a tax return, you've probably all seen a wonderful P&L that shows how massively profitable we are. Mike, why is it not? Why is that tax return, at least one of them, super important?
Yeah, I was actually going to piggyback on what Ariel just said. Is you may have a gangbuster 2023 right now, but until it's on paper showing all the deductions and proof that it's filed with the IRS, you can't use it, which goes back to the comparisons of somebody that's not self-employed, that is a W-2 or salary. You can actually use future income if they're getting a raise. You know, if they got a raise in December, we show the pay stub, but until they actually have those tax returns filed, they can't be used. And I actually have the self-employed handbook up, and yeah, you can use 1 year, but just like the double-edged sword of the VA handbook, it's very vague. You know, you have to have an in-depth development is required for conclusion of stable income on less than 1 year. And that's what Ariel was talking about, is you have to actually present your case to the underwriter of why this is an acceptable 1 year business and back it up with documentation, whether it's, they even said, general outlook of similar businesses in the area for likelihood to succeed. But they just want to make sure that there's not a history of that business there. Like Gay said, it's variable. And so the most concrete thing that you can show is what you filed with the IRS. What taxes have you paid? What have you claimed? Because what you claim with self-employment and what you show, or what you claim and show on taxes, and what lots of self-employed people make are going to be completely different in a lot of cases.
I like the direction that we're going with this. Ariel sort of kicked it off with, hey, guidelines say 2 years, but 1 year is doable. We talk a lot about get with an expert in VA loans if you're getting a VA loan. Tonight, if you're self-employed, get with someone who actually understands tax returns. Gay, what types of things, if you had someone come to you and they didn't have that full 2 years, but they're telling you the world is rosy, my business is solid, we're doing awesome. What are some of the things that you're going to be talking to them about that you would like to develop a file that you can hand to an underwriter and feel pretty good about?
Yeah, I mean, so if they don't have the full 2 years yet, you know, I think like Ariel and both Mike were mentioning before, you know, can you show me some sort of experience or background? Did the business exist before you? Are you the only one that's owned the business? Are you the sole owner? What sort of, like, did you have any big expenses this year that are going to be considered, they're going to detract from your income, so on and so forth. Like, look at those profit and loss statements. And I'll just say this, like, to anybody who's listening to this, that's thinking about starting a business, and I say this about rental income too. I don't mean to go off, on a tangent someplace else. But anytime you have a rental property or you have self-employed income, any sort of variable income associated with a mortgage, always make sure you're talking to the mortgage professional before you file your taxes. And maybe even make sure that if need be, the mortgage professional talks to the tax person so you can let them know what sort of things are allowed, what sort of deductions come out of your income, what get added back in and don't count, and so on and so forth. And I'm not saying cook the books or anything, but if you have the option to claim on 1 year versus another year, sometimes expenses can go, be spread out or something like that. It's good to know exactly what those calculations are. And I'll be honest, I don't have them memorized or anything like that, but there are definitely certain things that have more impact from a deduction standpoint than other things do. So it's always a great idea to make sure before you're filing, and if you know that you're getting ready to buy a house within the next couple of years, to try to reach out to a mortgage professional that understands really well self-employed income and can have a conversation with you and possibly your tax preparer.
So big
Can I add to
picture.
that real quick, Josh? Sorry.
Absolutely.
And Gay's 100% correct. It's not cooking the books. I've done this where I've not just with veterans, but with conventional lending as well, is for self-employed people. I mean, yes, I've seen some people that wake up and want to move, but most time people are preparing months in advance to buy a house. So like, especially the end of the year, like Q4 of 2023, it is a good time to get with your tax professional. Because again, it's not cooking the books, but you may have to take a heavier tax burden and not utilize all the benefits of our long-winded tax code if you are purchasing a property, so that you can show more income on paper, that your mortgage professional can look at what your debts are, what your goals are with purchasing a home, and it's just actively preparing. It's almost like, you know, you're going to buy a house, you want to save some money. It's just like the tax preparation version of doing that. And then once you're in the house, when the next tax period comes around, if you're not moving, then utilize that tax code. But it's good to do that well in advance. I mean, that's probably the biggest takeaway for any self-employed person here, is preparing as far in advance as you can. And now's a good time to do it, because I know most self-employed people are not even started with their taxes on January 9th. Most of the time they're hitting those extensions. But yeah, I'm going to repeat it again. Get with your professional mortgage planner and your CPA. Set up a conference call, set up an in-person meeting to actively prepare yourself for that, especially if there's going to be a tax burden if you are claiming more income, meaning you have to actually pay our wonderful government money. You have to prepare for that as well.
Yeah, and back into that. Oh, real quick, Ariel. So just another like little, you know, pro tip is, you know, by doing that, you may discover that it's either to your advantage or not to your advantage to either hurry up and file your taxes or take full advantage of the extension based on whatever happened in your business the previous year. If you don't have enough tax returns yet, maybe you want to go ahead and get that tax return in. If you have, you know, potentially some things that are, you know, going to be reducing that income on the actual tax return, but we can use a P&L instead because the business is already established, then maybe it makes sense to go ahead and take advantage of the extension. And, you know, so it is absolutely important to get all the parties together. Ariel, sorry.
You're fine, because you guys just said in the most nice and like kindest professional way. I love the two of you so much. You guys just said so nicely what I was about to say, but I'm going to reiterate it because both of them were at the lenders conference. There was an underwriter at the lenders conference, the VA lenders conference that the Department of Veterans Affairs puts on every year. A lender stood up, somebody that represented a whole lender, a whole company stood up and said, you guys dinged us for this. You said we could do this and then you dinged us for this. Self-employed income is the hardest income for VA loans to get qualified because the VA doesn't budge on anything. So we like to know they're saying as far in advance and as nicely as they can, let us know if you're a small business owner, because before you file taxes, there's income that we can't use that you're going to write off. And you may have to you're going to have to pay more to get a house if you're self-employed because the VA doesn't give us that. Now, as much feedback as we can possibly get is helpful. I will say that too. So we'll save comments on here, right? Because I'll take this whole comment section to the VA Lenders Conference this year. They only give us the ability to add back certain things. So we can't add back without specific documentation a lot of income that you're going to write off, like depending on what you do for a small business. One-time expenses, we can only add those back, not on VA. What are the other things we can't add back? We can only add back mileage and the use of home. So it can get very expensive very quickly if you're self-employed.
Depreciation's one you can add back, but it's very limited.
Yeah. Depreciation. Oh, but that's good though. So if you're a truck driver, we can normally add that income back. For veterans that are truck drivers, it's normally pretty easy to qualify them self-employed.
So we always talk here on the show that it is never too early to talk to a lender. If you're self-employed, it is really never too early to talk to a lender and to include your CPA in that, because we're saying do not file. Once you file it, it's on record with the IRS. And yes, it can be amended, but that opens up a different can of worms. So we're almost telling you to do the worst of all possible worlds. Get with your tax preparers early in the year, then hold it and sit on it and go talk to your loan officer. Then let the two of them talk together and make sure that you're optimizing your situation for maximizing your qualifications. Ariel?
And to add to that, Josh, if there is anything borderline before you file, your tax planner or CPA can put together a draft, and any decent lender can get a second opinion from an underwriter to say, here's my math, here are the tax returns, Mr. DEVA underwriter or Mrs., can you check this and say, we're on the same page here? Or if you come up with something different, can you explain how we got to the different number? Then you can do that even before you file so that you know you're good to go.
I forgot. There was one loan. Actually, there's been 2 loans now that I think about it. So this is an exception I have in writing from the VA multiple times. So I will say that if anybody needs a copy of this, let me know. If you're a truck driver and you have a contract, you're 1099, but you have a contract with somewhere like Dollar General or one of those companies that's going to give you a minimum number of stops. I have had success twice with 2 different veterans who have copies of those contracts that guarantee a minimum number of stops. And we just use your worst case scenario for deductions because they have to report to stops for, again, minimum number of times. That has worked. We have to be able to get a copy of the contract that says this is the minimum number of stops that you're going to get. So that's the caveat to that.
And with that, Ariel, what were they saying? Use the expenses from the tax returns for the last 2 years, calculate the top line from the minimum stops, and then the expenses from the last couple of years?
No, so the veteran that I had, he had gone from being a W-2 truck driver to being a 1099, but he had a contract with Dollar General, and the contract said it was X amount of stops, minimum number of deliveries, etc. And it gave us the criteria to establish a baseline minimum income for him. And then because we didn't have expenses for things like mileage and what he was going to wind up writing off on taxes, we wound up just, how did we do that? I think we used his 2-year history of deductions for like federal income taxes, and we used the W-2, which wound up being way more than he would have paid for the deductions, like way more, because self-employed individuals typically don't have as high of state, Social Security, or federal income taxes, and I think we leveraged that way. But since we had the minimums, he also owned his truck outright, so as far as expenses go, he didn't have expenses aside from maintenance. Very specifics to each file, but I wanted to put that out because there's a lot of truck driver veterans that I know.
And at risk of sounding like a broken record, the big takeaway there is you're probably not a trucker. You probably don't have the same situation. But it is important to know that an experienced, knowledgeable VA lender can know what's reasonable, how to get the information from you, and how to present it to the VA to find out if an exception can be granted in your situation. We jumped ahead a little bit and we're talking about what is in those tax returns. But in terms of documentation, self-employed borrower walks in the front door. One of the things they always ask, well, what do I need to provide you? VA loan versus some other loan programs will let you get away with 1 year, but how many years and what specific documentation are you needing from different types of borrowers?
Yeah, I mean, so it depends on, how are they getting paid? Like they could be self-employed, but still pay themselves W-2. They could be, so it could be gosh, sorry, I'm losing my train of thought. It could be an S corp, it could be Schedule C. I mean, so there's so many different. So basically, we need 2 years tax returns of. If it's all filed within your personal tax returns, then there isn't anything separate for the business than the personal. If you have business, then we need business tax returns. If there's partners or other business owners associated, we're going to need documentation from them as well. And if you pay yourself W-2s, and again, how far is it within the year? There's a certain point within the year that we'll need a profit and loss if we're, let's see, must be completed after 1/2 of the tax year has passed to verify income current income and stability of the income. So, and then, if there's basically any other business documents that we need, like the underwriters are going to verify that the business is a business, right? They're going to see how long it's been a business. They're going to check all of that. Usually I don't require to collect that information, but the underwriters will absolutely verify that. What am I missing?
What type of stuff are we talking about there? If I have a business and this is a wide open question, but I say you almost have two different types of borrowers that come in. The person has a small sole proprietorship. Say someone started an Etsy store 2 years ago, and you ask them pay stubs, W-2s or business tax returns. They look at you, their eyes gloss over and go, I'm just a sole proprietor. Well, in that situation, what are they going to provide you?
Yeah, so that's going to be that's all going to be in their individual tax returns.
And is that probably the easiest version for your loan officer to go through? If we have a self-employed borrower, is that the most basic, easiest one we can get? Someone
Yeah,
that has
where
a
it's
sole
reported.
files?
Yes, where everything is reported in their own personal tax returns. I have found that is the easiest. Full disclosure, I haven't done that many self-employed VA borrowers before, but in my experience, the ones that where everything is reported in their, they're a sole proprietor, kind of small, like a consultant or something like that. And it's all just reported right in their own personal tax returns. That tends to be the easiest to do. But if you're like a full blown business that has partners and, employees or, tons of inventory and things like that, it starts to get more complicated. Like it was mentioned before, K1, so partner type pay, that can be complicated as well. So it really just depends. You have to start asking just tons of questions about the business. How long has it been? How long has the business been formed? What type of business is it? LLC? Is it a corporation? Is it, how much ownership do they have? Like the list of questions is.
And that's the big one. So Mike, say you have someone roll in and say, well, I've got an S Corp and we started it 15 years ago. They've got this long history and it's a big business. And we go from little sole proprietorship with 2 pages of that Schedule C for us to analyze. What kind of can of worms does that open up going to a bigger S Corp? C Corps are pretty rare. I've seen a few in my years, but literally probably I can count them on one hand. So LLCs and S Corps are more common. What does that documentation start looking like for that borrower?
For 1065s and 1120s, they can get very long depending on, like Gay said, the complexity of the business and how many partners are in there, as well as a lot of things with businesses change each year. You got to really dive into those different schedules on those corporate returns because they may have, for example, like notes due and payable for equipment in less than a year. That has to be factored in, things like that. You can only really add so much to a Schedule C, for example. But you're going to have to bring in your 2 most recent, either 1065s or 1120s. And then a lot will depend on if they are a partner, how much of the business that they do own. Because you have to make sure when you're diving into those tax returns, say there's $1 million worth of depreciation. Sweet, we can add that back to the loss. Now we got $500,000 worth of income. But you go to the K1, they're only 10% owner of the company. You don't get to use that full $1 million. You get to use 10%. So that's why it's always good to have the full digital copies, or if you really want to print out 200-page tax returns, bring them in for us to look at, as well as I'm still old school. I manually calculate them. Then I'll put them into, there's tools that we have on the loan originating side that you can plug this data in to make sure that it adds up. I'm still old school with that. And then just not to go off topic, but to cover what we were talking about meeting with your CPA, one important thing when you are meeting with your CPA as business owners is we were talking about verification of business. Like, for example, I can go to the North Carolina Secretary of State and see how long a business has been formed and see who the authorized agents are. That may not always be the business owner, but sometimes we do need documentation from the CPA. The air quote term is comfort letter that the business is still in process and everything like that. But depending on which state you're in and the guidance that that CPA gets from their regulatory body, a lot of times they're not willing to write those letters, or they say they legally can't. So that's another thing that you want to address with your CPA up front is, what can you give me if they come back and I need to verify my business? Are you able to provide an email or a letter, or you can't do anything? Is there a third party that can help me do this? That's just another tangent with the CPA. But since we're on the tax return piece.
And you really, especially when you go back to those sole proprietors where we have a Schedule C, they haven't been doing it that long. They might not have a business license. They might not have a CPA. They may do it themselves. So it gets interesting when you have trying to prove that business actually exists and is still up and running, especially if we get to now, if we're in January of this year, we don't have within 12, 13 months of an actual tax return showing it's there. So it is a reasonable question for a lender to say, hey, cool, way back in 2022, I have a tax return that says they were operating and making money, but we can, as we get further away from that last tax return, have to deal with that. Ariel, I got a fun one here that we didn't actually put on the outline. So I would throw the curveball at you. A lot of times we get business owners, especially those sole proprietors, they'll have a business account and all of their money is in a business account. Are we able to use business accounts? Any specific restrictions or requirements that come up if we're using business assets for closing costs?
Yeah, we have to confirm the business is still liquid, because if we're about to pull a bunch of money out of the business for you to buy a personal residence, what's to say that money is not needed in the business? So there is a test. It's the liquidity test. I don't know how to do it. There is a nifty Excel spreadsheet for it, though. So I normally
Excel
say,
spreadsheet for everything with self-employed borrowers.
I say, hold please, thank you, I'll be back. And I go deliver those to my processor and I say, help. That's yes or no, green light. But there is a liquidity test. You can't jeopardize your business in order to buy a house. So we have to make sure that that's going to fly.
And that's where the CPA can come in as well. They can also verify if they're willing to say that it's not going to impact the business. And the reason we never try and be difficult here, guys, we don't like collecting more docs than we need. But what Ariel said hit the nail on the head. If you're pulling $100,000 out of your business, but you need that $100,000 for payroll because you own a pest inspection company and you can't pay your technicians for 2 weeks, then what the heck's going to happen to your business? That's why we have these liquidity tests for verification from the CPA that Josh can pull $100,000 out of his business to go buy a house.
Anything that you guys feel like we haven't covered, things that come up when you're dealing with a self-employed borrower, tips, tricks, just any kind of gotchas. The CPA letter is always an interesting thing to me. Is we're asking a CPA who will happily tell you, I don't audit this. I take the information that my client gives me and I complete the tax return. They're the ones signing it. I'm signing that I prepared it based off of the data they gave me, and they are signing to the accuracy of it. And then we have an underwriter says, hey, will you tell me something for a company that you prepared a return quite a while ago? So that one's always an interesting one to me. And it oftentimes just comes down to how big and stuffy is the CPA firm, and also how close of a relationship you have. A lot of people say, oh, it's my buddy. He's done my taxes forever. He'll write whatever you want. Or no, they said they just don't do that. They're a big firm and there's too much liability and they're not going to do it. So if you're asked for that CPA letter, it absolutely can be a nothing. It can be an issue.
So I have a question, because this comes up with a couple of other documents that we have to provide for lenders. And this has nothing to do, don't get me wrong, I'm not talking about people lying or anything like that. But what does anybody, and this is like a legit question because I don't know the answer, what is the accountability of the CPA? Like, say they sign it and say, oh yeah, it's liquid. The borrower goes under contract, they get the house, a year later they foreclose because, it wasn't truly liquid or whatever. I mean, are there any implications for that CPA?
I don't know what you guys experience when we ask for something like that. It is usually some pretty fancy legalese that comes back that says, I haven't audited their financials. I am not their bookkeeper. Based off of my knowledge of preparing the tax returns for the last 7 years, this is what I'm aware of. Unless, again, it's someone's buddy who's willing to say whatever, which I would assume they would have some pretty hefty liability there if they did something without documenting and validating it was accurate. Ariel, Mike, what do you guys think?
I've always gotten pushback, at least in North Carolina, that whoever their regulatory body is says that they're not supposed to do that.
Yeah.
Similarly, Ariel's probably ran into this with North Carolina properties. Like our state insurance board says they're not supposed to share replacement cost estimators. So it's similar to like that, where they're going to lean on, if it's a law, yeah, of course they want to follow the law. But if it's like a gray area and there's a regulatory body, then they're going to lean on that for a reason to not provide it. Or it could be like you said, Josh, they could be working for a large firm and it could just be their company's policy deemed on how they, strategize risk and everything like that. Whether it'd come back to answer Gay's question, I have no idea. I don't know how deep they would dive, because then you'd be really getting into the area of, was this a fraudulent application, and what did you do there? I know they're going to call one of us that originated the loan,
Right.
back up why we did what we did, but I don't know what their liability would be. That'd be a good question.
Yeah.
It would most likely circle back to how did you document it? You've said this in the letter. What documentation did you have to support it?
Mm-hmm.
I don't think those cases go anywhere, and I will give you personal experience from that. I had a veteran who used self-employed funds to purchase a home with his VA loan, wound up foreclosing and having to file bankruptcy. And the reason he had to file bankruptcy was because he was in airborne and his rotator cuff started to very quickly deteriorate and he could no longer lift his arms above his head. So that was after he bought the first house, and we did a second loan when he got his VA disability kicked in. So there are very nuanced circumstances to a lot of that. I would think it would matter for the purposes of compliance that enough context was established, because we do the best we can to certify. If the lender will let us close the CPA letter and a veteran was to foreclose, I can't imagine without enough context and details established around that number one, foreclosure prevention measures weren't taken, and two, if it got to foreclosure, that was the single catalyst.
Yeah. It was genuinely just a curiosity. Like, I'm like, well, what happens? What happens? And my thought was like, why is there pushback? Is it because of, like you guys were saying, the regulatory bodies, or is it because of the potential implications if it's found to be invalid?
So when I've talked to the VA, like I remember stepping aside with some of the policy team. I can't remember if you were there for that, but when we stepped aside with the policy team, the risk associated with service members or veterans who are self-employed for less than a year, or the risk associated with foreclosure, tends to spike, and VA foreclosures are already pretty low. And the VA wants you to buy a home, and they want you to maintain and own that home for as long as you choose to own that home. They don't want you to lose it. So they do their best to mitigate circumstances where they see pockets of issues. Like that, they were pretty stern with us at the lenders conference about self-employed income. Like they didn't, at least to me, they didn't feel like they were going to budge on making adjustments to it without a decent amount of evidence to prove otherwise. Same thing with departing primary, but that's not what we're talking about. Like I feel like this is the hill they are prepared to die on, and they do it because they want you to still own a home after a few years, and they don't want you to lose it.
Yeah, I mean, at the end of the day, I mean that's what really any regulatory body associated with mortgages wants, right? They don't write these rules because they want you to foreclose. They write them because they don't want you to foreclose. They want you to maintain the home. They want you to be a homeowner. They don't want your credit to be impacted. And so they write rules to keep us inside certainly barring any unusual circumstances, but they write these rules to mitigate risk for the lenders and to keep people housed and in homes. So yeah, that all makes perfect sense.
And that it's worth underlining what you just said there. There's two reasons for the underwriting guidelines: to make sure that the loan is safe for the lender and the financial system. We saw the flip side of that in 2007, 2008, 2009. But more importantly, a lot of the policies that our government put in place in the 90s and the early 2000s, where they said homeownership is good. We have all of these good outcomes because of homeownership. Let's make policies that make homeownership easier.
Yep.
And they put people in situations where they were not prepared to succeed. So the VA, any lender, these guidelines are primarily written to make sure that you have success, to protect them, but that you also get to keep that home, not for a month or a year, but for as long as you want to live there.
It's all ability to repay is the industry term, and it might seem like a pain in the tail. If I wasn't on this video, I would have used different language, but it's all in place to make sure that that person who's buying the home, not just with VA, but conventional, is ability to repay, to not put them in a poor spot. Because the other thing is not just ability to repay, and worst case, you lose your home through foreclosure, then you're ineligible to purchase anything for 3 to 7, maybe even more years, depending on when your credit comes back. So it's not just protecting you now, it's protecting you down the road.
Mm-hmm.
That's why we go through this and ask for what we ask for. Everybody thinks it's just to protect the investors behind us, but the true reason is not just them, but like you guys said, to protect the homeowner as well, to protect that generational wealth for that veteran and his family or her family.
And going back to the beginning of the show, their definition of effective income: verifiable, stable, reliable, and anticipated to continue for the foreseeable future. You need all of those things to be able to pay your mortgage, unless you're going to win the lottery at some point in the future. Those are all things that do need to be documented. So all of these policies and guidelines are there for a reason. Self-employed borrowers are a little bit unique because there's not a third party that writes them a check. It's not as easy as asking that person. It's not as easy as getting a pay stub and a couple of W-2s and going, there's my income. So definitely more complex, but always for the benefit of the veteran. You guys have done a great job of going through all of those details. Would love to give each of you an opportunity of your best words of wisdom for any self-employed veteran looking to step into the market. I think we all agree that step number one is get with your CPA early and let your loan officer review prior to doing anything with that return. But beyond that, Gay, what are your thoughts?
Yeah, just plan. And if I would say if when you're doing those taxes, if it is reducing your tax burden, it is probably making you less qualified for your mortgage, more than likely. not 100%, right? But there's a good chance it's making you less qualified for a mortgage. So, and don't be mad about that, right? Like, guys, don't be mad at us. Like, we don't control it. We don't make the rules. And again, back to that, we want you to be able to stay in your home. I get it. Like, everybody wants the best of both worlds. They want their cake and then they want to eat it too, right? They want to be able to write off everything on their taxes, but then they want to be able to show all this income to qualify for the big $1 million home. And unfortunately, it just doesn't work like that. So just plan. That's my best advice.
I'm going to add on to the planning. Okay, so not only do we need the tax returns that you filed with the IRS, we need to get the receipt that you filed. So we have to prove you filed. We have to have you get your tax transcripts, which is the digitalized record that the IRS acknowledged your tax returns. They received them, they processed them. Here's your bill. We have to get proof of that. So if you are a newly self-employed veteran, do yourself a favor, get with a loan officer first if you're trying to buy a house, figure out what the timeline is, ask your CPA how long it's going to take for the IRS to process your tax returns, because we can't close till we have completed transcripts. Ask me how I have found this out the hard way. Ask me how I know this.
How, please. Ariel, how did you find this out?
No.
Wait, you're acting like the IRS moves slow.
Just a guess. I calculated the number of hours I spent on one particular veteran's loan who did eventually close. It was 48 hours I spent on hold with the IRS. I can sing the song. Okay, I can sing the song.
There's an IRS song?
There's a jingle. There's a jingle for the self-employed department when you click the button and it says, are you getting personal or 1065s?
Oh my goodness.
Well, the best part is most places under-promise and over-deliver. So I think they actually want to scare you away. You call and they say, the wait is going to be 14 hours because they want you to hang up. But then you're like, can't possibly be 14 hours. But then they deliver and give you that.
So yes, pretty much that about sums it up. Unless you have to go off the IVR branch to any other department, then it's just 10 times worse.
Awesome. Mike, any words of wisdom for the self-employed veteran?
Yeah, and it's not just self-employed veterans. There's no such thing as planning too early to purchase a home. The further you get out in front of your goals, the easier it is to accomplish them. Even I've had people, I'm a year out. Well, let's look at it. Let's make sure we're good to go. So there's no such thing as planning too early. Keep diligent records. If you're using QuickBooks, make sure it's updated. I've had self-employed people. This one wasn't a vet. They did everything manually on paper. That was a nightmare. Make sure you're keeping diligent records. And then if it takes you a while to find a property, and make sure you keep updating your loan professional, what you're doing. If something changes with the business, did you add a partner? Did you change anything with it? Especially this time of year when we're into a new calendar year, because regardless of what your fiscal year is, our underwriters work off calendar years. And to add on to what Gay said about the tax burden, don't get shocked if there is a tax burden. I always tell folks is we have loan programs for people that write off everything on the taxes. They're called bank statement programs. They're called non-QM programs. They require a lot more down payment and a lot higher interest rate. So while it may suck at the time, you can either pay taxes or you can pay
now or pay later.
You can't have it both ways.
Yeah.
And I will piggyback off of what Gay said, and then Mike, you kind of followed through with that, is quantify and know what that tax savings is. So as an example, we're not saying, as Gay said, cook the books, but you are not required to take any deductions. If I work for someone else, I can't deduct my cell phone bill. If I work for myself and I use that for work, I can deduct it. Doesn't say that I have to deduct it. So know if there's $10,000 of deductions that I don't have to deduct, know what that does. $10,000 is a little more than $800 a month for your qualifying income. When you go for a well-qualified, high credit score VA borrower to a 60, 70% debt to income, that's $500 or $600 worth of qualifying payment. But it doesn't mean that you're going to pay $10,000 more in taxes if you don't use it. You need to know your state rate. You need to know the federal rate, and not just the little table. You need to know after my expenses where I'm at. Am I paying 32% federal and 5% to the state? Okay, for $10,000 that cost me $3,700 in tax bill, but it's allowing me to qualify for $500 or $600 more of house payment. And it kind of goes back to your CPA and your loan officer working together and being able to guide and advise you. Only you can make that decision of what is most important in terms of minimizing tax bill and qualifying, so that, as Mike said, you don't have to get a non-QM loan and pay 9% with 30% down.
Yeah, it's true.
All right, everybody. I appreciate you taking the time, sharing your wisdom tonight. We will be back with a new crew of experts next Tuesday and continue going through it. Thanks, everybody.
Thanks, everyone.